Hello and welcome, I'm Jo Grimwood. This is Property Question Time, the true interactive property show where you get to send in questions to our panel of property experts who join us and are able to give some sage advice to you, whatever your question is about property. Now today I'm joined by a fabulous trio. We have Paul Mahoney, who is the MD of Nova Financial. Welcome to you, Paul. And Evan Maindonald, founder and CEO of Melt Homes. Hi. Great to have you back, Evan. Tony Gimple is our last guest. He is the founding director, Less Tax for Landlords. Hi, Tony. Well, gentlemen, let's start with our first question without delay. We've got some really great questions today for you. Evan, this one's for you. I own a flat in a block of 8. We own the freehold and manage it ourselves, but it's a lot of work for the people that do it. Now, we do try and share it out, but it's not easy as it's a mix of owner-occupiers and buy-to-lets, and some people do more than others. We were wondering about getting someone in to manage it for us. Is this something worth investing in?
My initial reaction is that probably yes. I think things that you try and manage by committee don't usually work out being managed particularly well. And unfortunately, when you have a group of different people, some of whom are living there, some of whom maybe are buy-to-let owners, it's very difficult to manage and balance the needs of those people. So I think absolutely in that case, the best thing to do would be to get an external management company, to appoint an external management company to manage the block for you. I would recommend going out and talking to 2 or 3 at least management companies. Find one that you're comfortable with, that you think can work with the style of the people in the block, and obviously you'll need to get the consent of all the owners to appoint that management company to manage the block. Make sure that you're getting good value for money. But the fact is that an external management company, they manage properties all day, so they're set up to do it. And so they can do it a lot more efficiently than you as individuals can. You may save a little bit of money by doing it yourself, but really in the long run, I think the time and effort that you put into doing it, and the question of trying to balance everybody's needs within the block while remaining independent of those needs or desires can make it very difficult. So yeah. I think avoid the politics, save yourself some time and effort, focus on what's important in life, the things that you're actually really doing, and get someone else to manage it for you. That would be my advice.
Save the headache and the stress.
Save the headache and stress.
Absolutely. Yeah. Anything to add, gents? Any musings?
And it's a legitimate business expense, so it's tax deductible in its own right by employing the agent.
That is a point that I'd missed, yes.
Yes, okay.
Do the value of buy-to-lets at resale take into account the value of the income as well as the value of the bricks and mortar?
Okay. Well, if you're selling to a landlord, it would certainly be a consideration in their minds as to the income that property can generate. And therefore, if it makes it more attractive to landlords and increases the demand for the property, then the value is likely to increase. So as taking it away from that question, the value of the property is only worth what someone's willing to pay you for it. So it's all about supply and demand. And if there's strong demand for your property, then the value, or increasing demand for your property, then the value will increase. Of course, if you're selling to an owner-occupier, they couldn't care less about the rental yield. So that's not going to impact, the rental income is not going to impact upon the value of the property, because it's not part of their criteria. Actually valuing from a valuer's perspective, I would say probably not. The income isn't really considered. It's certainly considered as part of your ability to get a buy-to-let mortgage. So it needs to stack up. It needs to be a certain point to allow for a certain level of mortgage. But again, it is actually about the supply and demand. A valuer will look at what they believe you can sell it for in the resale market. If it's a bank's valuer, they'll generally look at that quite conservatively to sit on the conservative side of the fence. But so far as whether it's considered in the value, it depends who you're selling to as to what their criteria is.
I could maybe add a little bit to that. I think there's a fundamental difference between commercial and residential property in terms of the way that it's valued. Nobody buys a commercial property because they want to live in it, so it's not there's not a lot of emotion about it. It's about money. Is this a good investment for me or not? So in essence, when somebody's buying a home to live in, that decision is, do I want this? Do I desire this? Is this the best thing that I can get for me, for my money? It isn't necessarily, although many people do regard their home as an investment, the investment aspect of it isn't necessarily the thing that's at the front of your mind. When you're buying a commercial property, the valuation is based fundamentally on the investment income that you can get from that property. So it'll be valued based on yield, and that yield will be the yield that the investor is seeking on the investment. The yield that's used for the investment will depend on the security of the income stream. So in other words, if there's a tenant in the property, the covenant strength of that tenant, the quality of the tenant. So in other words, if you have a Tesco in your property, they have a very strong covenant strength, you'd expect a lower yield than if you had a one-man band who's operating a hardware shop or a bakery. Yeah. So that fundamental difference between residential and commercial property needs to be borne in mind, and buy-to-let actually sits somewhere in the middle of those two things. Now, there are ways that you can take residential properties and you can turn them into properties that would be valued on a commercial basis. A good example of that is a house to HMO conversion. So by increasing the level of income that you get out of the property, you may be able to actually increase the capital value by getting somebody to view it as an investment rather than a residential property. So that's something that's worth thinking about.
Actually, it's more fundamental than that. It's, are they going to view it as a business?
Sorry?
Are they going to view it as a business?
Well, exactly. And so how do you get if you can get your property to cross over from being something that's viewed as being residential to being viewed as a business, then you can potentially add value if you've got a high level of rental income and you can get it to be valued based on yield.
Yeah.
Fabulous.
And being a landlord is running a business like running any other business.
Yeah, absolutely, Tony. Yeah, so I have a question for you now. I'm thinking of using my pension lump sum as a deposit to buy rental properties, and I've heard that if I use a limited company, I won't be personally liable if the business goes bust. Is that true?
No. Limited liability companies are wonderful things, and your liability is limited as a shareholder to trading losses. If you don't service the boiler, that's not a trading loss. And as a director of the company, you are unlimited personal liability. If a lender on commercial mortgage terms is lending to a limited company, particularly if you're a first timer with no balance sheet, they're going to ask for personal guarantees from all the directors and all of the shareholders. And to think of investing your pension lump sum, all of it, in one thing, you really need to seek advice. And whilst you've got to look at the worst first, that what happens if, through no fault of my own, if you're starting up a business and looking to run away from your liabilities if something happens, well, perhaps you shouldn't be in business in the first place.
Okay, great, Tony. Now, do you happen to have a golden nugget for us?
Yes. On this show, you've got three people with three different sets of expertise.
Yes.
If you're going to be in business, as a landlord, it's critical that all of your advisors work together as a team. You may well have an accountant, you may well have a lawyer, you may well have a business planner or a financial advisor. But when was the last time they all talked to each other, socially, let alone about you and about your affairs? So the golden nugget is bring your advisors together in one place and make sure they all get the same message and then collaborate to help you achieve your goals.
Great. Okay, well, we're going to throw to a break. When we return, loads more questions for our expert panel right here at Property Question Time. Hello there, welcome back to Property Question Time. I'm Jo Grimwood. Today I'm joined by Paul Mahoney, Evan Maindonald and Tony Gimple. Welcome back, gentlemen. Now we're going to start with a little tidbit, a golden nugget from you, Evan, if that's okay.
Absolutely fine. I'd like to talk a little bit about a strategy that can be used to build an investment portfolio and to achieve great rental yields on properties. So what I'm going to talk about is house to HMO conversions. If you're looking at buying a property to maximise your rental yield, then one way of doing that is to buy a house and convert it to a small HMO. Now, unless the local planning authority has brought in something called an Article 4 direction in the area, in the particular specific area that you're looking to buy in, and you need to check that obviously before engaging this strategy, then you can convert a house to an HMO without requiring planning permission, as long as you don't have any more than 6 unconnected occupants in that HMO. If you have more than 6, that classifies the property as a large HMO, and you need planning permission for that. So the point is that by doing that, by converting the house to an HMO, you can get up to 4 times the amount of rental income that you would simply by renting the house out as a house. Not only that, once the house has been converted to an HMO, then you may potentially be able to increase the value of the property. So you can have it valued on a commercial basis, which means that you may be able to buy a property, increase the rental income from it, remortgage it, and take out the money that you put in the first place, and then go on and do another one. So it's a way not only to build a stream of rental income, but also to actually build capital value in the properties that you're buying.
Brilliant. And what areas should you be looking at if you want to do an HMO?
So HMOs are basically houses where people take individual rooms. So they have shared facilities. The definition of an HMO is a property that has shared facilities. So it might have a shared kitchen, or it might have a shared laundry, it might just be a shared washing machine. Generally, they tend to share communal facilities, and people have their own individual bedrooms. So they tend to work best in areas where you've got a lot of students, or people who maybe can't afford the rents in the area or in that particular area where rents are quite high, and you have a community of people who live in that area or need to be in that area or need to live in that area for some reason, but maybe will struggle to afford to actually rent a whole property themselves.
Okay, fabulous. So I have a question for you, Paul. I've just come across the channel and I'm hooked. Fabulous. Keep watching. I'm really interested in learning how to get into property. I have a 10-year business plan ready to go, but I need to find out how I can get finance to get started on my journey. I'm hoping someone from your team can give me some advice.
Look, I think it's fantastic that you've spent the time to put together a plan to work out what you're going to do. I'd say the finance is probably quite an important part, or should form an important part of that plan. So I'd be interested to see what the current plan is. I assume it's acquire one property now and another one next year, and so on and so forth, which is a fairly common way of building a portfolio. But certainly worth reviewing that plan. 10 years is a long time, firstly. I'd say it's, so far as making a property investment, I'd say you probably want to be going into it with a sort of 7 to 10 year time frame per purchase in any case, given that it is a long-term investment. But so far as sorting out the finance, it seems from what this person has said that they're a first-time investor, they're looking to get started. So they need to work out, assuming the plan hasn't already done it perfectly, which I'd say given they're a first-time investor, they probably should seek some advice on reviewing that plan, make sure they're very clear on what their current situation is, what their goals are, and what the best strategy to get them there would be, and then selecting the right assets to fit that strategy. Now, finance obviously forms part of that, but obviously different types of finance work best for different types of property investments, and the types of property investments should be determined by the strategy rather than the other way around. So it should be about the benefits rather than the features. So my best advice to someone who's starting out is to seek advice. Yeah. So make sure that you're very clear on what you're working toward, how you should do it, and then have someone actually help you start doing it. As a common recurring theme on this show, with property investment, especially with all the changes recently, it's a lot more complex than it's ever been before. There's a lot more to consider, and therefore there's a bigger gap between what works and what doesn't.
Okay, great answer, Paul. So Tony, this one's for you. It seems that small accidental landlords will suffer the most under the Section 24 and the tighter buy-to-let mortgage lending rules. What would you advise those with only 2 or 3 properties to do?
Stop worrying about it. There's a perception that smaller landlords will be affected, but actually not so much. Probably at least 90% of the people we see don't have a Section 24 problem. In essence, if you've got 3 properties, you're a basic rate taxpayer, keep going. Put the rents up to the maximum the market will bear in the area. Make sure you log all your legitimate business expenses. Speak to someone about how you can grow the portfolio. So Section 24 does become a problem.
It's good advice. Tony said so that it does become a problem.
Oh, I didn't catch that.
And what I wean from that is create more income, so that you have to deal with your tax problem.
Yeah, and at that point you can restructure the portfolio into a more tax efficient vehicle.
Yeah, absolutely.
Yeah, that's right.
And like we were saying earlier on, you know, obviously the more you're bringing in, the less relevant tax becomes anyway.
And for a couple, say, up to about £90,000 total income between them, that's when the problem begins. Or actually, it's just before that, because the minute you're about to go over, you can move from basic rate into higher rate very quickly. So it's just being aware of what's going on. But with 2 properties, basic rate taxpayers, don't sweat it. Just get wealthier, worry about the tax on the fly.
It's also worth noting that basic economics dictates that ultimately if additional costs or obligations are placed onto landlords, in the long run rents will simply go up. Supply will shrink, there'll be the supply-demand balance will kick in and rents will rise. So you need to think about what the market is likely to do as well as what the effect is in terms of cost on you personally. I think from my point of view, the issue is more about the additional administrative burden that's placed on landlords in terms of ensuring that their properties are energy efficient, ensuring that all of the right certification is in place, gas safety certificates, all of the other things that you need to ensure, and mandatory licensing is being brought in by many councils now as well. So all of that stuff adds quite a big administrative overhead. And so if you have multiple properties, you can spread that over multiple properties. If you've only got one, it can start to become a little bit of a burden.
Yeah. Okay, great. So Evan, question for you. My property isn't selling and it's been on the market for over a year. I've lowered the price but still no luck. What am I doing wrong?
Okay, well I think you need to take a good close look at the way that the property is being marketed. And when I say the way that it's being marketed, I mean both in terms of the way that it's being presented online through the portals, Rightmove and Zoopla, I'm supposing are probably where it's being listed on, and also the way that the property is presented when people come around to look at it. So it's important to get other people's opinion on this. Because it's your property, you're not necessarily going to see the things that a buyer will come around and notice. They might think that you may think that your property is tidy, they may think it's messy. To get the maximum value for your property, you need to have it presented in perfect condition. Otherwise, a buyer will simply try and knock the price down. Another option, another thing that you could think about doing is getting a new agent round to have a look at the property, rather than get a different perspective. Ask the new agent to be as honest as possible with you about the reasons why they think your property is not selling, whether it's price, whether it's the photographs, the presentation, or maybe even the property just description. Also, perhaps ask a friend for some independent advice on what they think about the way that the property is being presented and marketed. And finally, I think, well, actually not finally, I've got a couple of other things. Talk to your existing agent about the buyer feedback that you're getting from those people who have maybe viewed the property or who have inquired about it. Ask them if there are any particular reasons that are coming up over and over why people are not maybe putting an offer in or maybe not going for a viewing. That I think will give you some interesting research and information. And just one other thing, if the property's been on the market for a long time, it can become a little stale. So often what happens is when a property's first listed, it can generate a lot of interest. When it's been on the market for a long time, it tends to drop down the listings. People don't notice it because they see the same thing come up over and over again. So taking it off the market, getting some fresh photographs, a new description, and then relisting it 2 weeks or maybe a month later can result in some sudden interest being generated. If you do that, make sure that you put it back on the market at a good time of year to be selling properties. Don't put it on the market when everyone's away on holiday in June, July and August. Put it back in at the end of December so that people will see it over the Christmas break, and it's on the market in January. That's a great time to be selling property, or when people come back from their holidays. But just make sure that you think about what the right time of year to be selling a property is. It isn't necessarily when you think it would be. A lot of people think that it's in the summer months. They're actually probably one of the worst times of the year to be selling properties. Okay. So hopefully that helps.
Great. Yeah, and it's interesting what you were saying also about how you don't notice things in your own property. Yeah. I mean, people forget how integral it is to have, the plug-in air freshener in each room so it smells fresh when people walk through the door, because you can be desensitized to things like that if you're living in a house.
Well, and you can be used to leaving things in a certain places.
Yes.
That may look messy to other people. Maybe it doesn't to you.
Yeah, excellent. Okay, I think we have time for one last little piece of advice from Paul, little gold nugget from you, Paul.
We touched on it earlier, but there's been some recent changes around energy efficiency of properties, specifically buy-to-lets, and essentially a raising of the standard. And so far as I know, this was previously enforced by local councils, and by not following it, you were risking a fine by your local council. One of the recent regulatory changes is that lenders now need to certify that you have these things in place. So if your properties aren't up to that standard, then you won't actually be able to get a mortgage. So that's something you need to be aware of, because if you buy a property that is going to be very expensive to get up to that standard, well, that's a massive extra cost, or the property may be unmortgageable.
Well, that's all we've got time for today, ladies and gentlemen. Thank you to Paul Mahoney, to Evan Maindonald, and also to Tony Gimple, our panel of experts today. Now, if you'd like to pose a question to our panel of experts, you can do so by sending it in to us by email, which is info@property-tv.co.uk, or logging your request on our website. We look forward to seeing you next time here at Property TV. Bye for now.